Good morning, everyone. I am CA Shruti Gupta, moderator for 31st Valuation Manthan session, Valuation of Financial Instruments, organized by the Valuation Standard Board of ICAI. We are delighted to welcome you all to an empowering journey through valuation expertise. Let us start today's session by welcoming the Honorable Chairman of the Board, CA Hansraj Chugh sir, for his opening remark. CA Hansraj sir is a Central Council member and the Chairman of Valuation Standard Board. Sir, request you to inaugurate the session.
Yeah, thank you, Shruti. At the outset, I welcome each one of you, the participants from the nook and corner of the country and the beyond also. The guest speaker of the day, Anurag Singhal I welcome you on behalf of the board and on my personal behalf and on behalf of the co-chairperson. She may be joining at any moment. Preeti Savla, she hails from the western part from Mumbai. And now, naturally, the Shruti here as a moderator of the program and the team from the office, Dimple and the Rahul, they'll be assisting us in making the success of this program and all technological aspects in being looked after with the tech team. You see, like once you start anything with a big vision and big thought, yes, this will be brought into the for the benefit of the members, those who are interested into the valuation side as a professional of that particular area to be looked at for the growth also and for the livelihood also. So then it was been thought of ki it may end in between, but fortunately, with the support of all external, internal, and the tech, all team members, this Valuation Manthan series is growing with leaps and bounds. Today we are on the 31st in the row, and today the subject will be valuation of the financial instruments, which are naturally, you see, like there are the many financial instruments. The valuation keep on changing on a day-to-day basis or sometime minute-to-minute basis even. How to value and how to make best out of it for the informed decision to be taken by the those who are the stakeholders. The same way, many of the bigger things which wherever the valuation requires with that has already been made through the last 30th uh, 30 series of the Manthan, and the subsequently many more will come on the way where the different view or the different system can be really been for the benefit of the, and it is not limiting to the speakers, because technology has brought us more closer. The our speakers sitting at a different location, maybe within India or across, maybe from the different part of the country even. So that is the benefit of which we are availing with, which we are getting with, and hopefully the justification has really been for the participants also. Sunday, naturally, we feel like it's a day which has to be different, but this valuation standard board has kept you busy on this Sunday also. Many Sundays has been really, and I appreciate the way this has been really been running into, or thousands and thousands of the participants are there in our programs. That shows, yes, there is a encouragement, there is a need, there is a hunger for the learning, and learning not limiting to the theoretical approach, but with a practical exposed or the best of the speakers. So that is the advantage of these programs are. As far as the valuation standard board is concerned, fortunately this board has been brought with a different structured thought process, bringing out some kind of standardization, so that it's not beyond everyone as to, because this carries a financial values, financial decisions. So naturally there has to be some standards, and the fortune this board has developed many standards, and there are the many processes by which some standards are under review, and some new standards has to be brought in the time to come. And I'll request each and every participants also, wherever you feel like you can be associated with the board as a team, as a group, or as a some kind of the speaker even. So with an open heart, we are open with it. Nowadays, we are planning many standards to be brought in, and the IBBI also in the picture. They also requested us to bring out some good standards for them also, wherever the stress are of that nature, where the CIRP is going on, or some liquidation process has been started with. With those kind of process, as we are already with the regulators hand in hand, so that we can give best to the system of the growth of the economy. And more so, you all may be aware of this. Our registered valuer organization of the ICI has already been authorized by the IBBI to undertake, not limiting to the financial instruments or financial assets, but going forward, we have already been authorized, and the certificate already issued for the land and building and the plant and machinery assets also. So I'll request each one of you, if you have a friends around you, those who are technically qualified in the land and building or the plant and machinery, do refer to this board, so that we can also start and gear up for building up the standards therein also. So I'm quite hopeful that our justification will be there, and our best of the speakers around us, Anurag Singhal, will be taking us through the through the valuation process of the financial instruments. With this initial remarks, I welcome each one of you, each and every participants. I welcome Anurag Singalji and the team there, Shruti and office team Dimple and Rahul also. So now over to Shruti. Now over to you.
Thank you so much, sir, for sharing your words of wisdom and directing us in the right direction. Thank you so much. So, without any delay, I would like to start with today's session. We are all eager to learn about financial instruments. So, I'm delighted to welcome our speaker, CA Anurag Singalji. Thank you so much, sir, for being here. So, sir, you are a practicing chartered accountant with expertise in valuation domain and also an IBBI registered valuer for S and FA. Anurag ji qualified in November 2007 with AIR 22. He is also an alumni of IIM Ahmedabad. He holds a vast corporate finance experience of 14 years, and he has also worked with ITC, Tata Steel, and Aditya Birla. Anurag ji is an avid speaker and have taken sessions with ICMAI RVO Bangalore Valuers Association. Thank you so much, sir, for gracing us with your presence. We are all eager to learn from you. Thank you, sir.
Thank you, Shruti, for your kind words. And I'm in this session. Thank you, Hansraj sir, for this opportunity. And thanks, Rahul. So without much ado, I'll start off with complex financial instruments. Now, the thing here is that in financial instruments, so if you look at the entire hierarchy of financial modeling, the whole concept of the valuation hierarchy, so typically what we see is that at the very big.
I'm so sorry to interrupt. Do you want to share your screen?
Yeah. I'll share my screen. Yes. Yes, if you look at the hierarchy in terms of complexity for the financial valuation profession, which I have been practicing since the last 1.5 to 2 years. So plain vanilla, for example, if you have an RV certificate for issue of shares under Section 62 of the Companies Act, that is the most simple one, where essentially what you do is that you can adopt either the income approach or the market approach or the cost approach. So basically what happens is that you can either use the DCF method and do the projections of the cash flows and bring them to the present value, assuming a particular WACC for the company, etc. You can use a market approach where you use something called CCM, comparable company method, where you will say that, okay, I have a startup in the D2C space and Mamaearth IPO is at this times EBITDA and Nykaa is at this time EBITDA, and I can come to my multiple based on these values and come to my approach. And cost approach is where I can do a balance sheet approach where I have the liabilities and the equity and I have the assets on this side. So what I do is that I take the net assets, and that is a proxy for historical cost that is incurred to bring the company to its current state. So this, in terms of the hierarchy for the valuation assignments, the bulk of the valuation assignments will be here. However, the true value addition, and then once you go up the hierarchy, you have things like ESOP valuation, you have things like purchase price allocation, and then I think at the complexity of this is the financial instruments, which will really be something which you will not get as a skill set across the whole thing. And the financial instruments could be a lot of them. So my humble submission here is that if we can actually get into understanding financial instruments, how do we value them? And today we are going to cover what is the broad thesis around financial instruments in terms of Ind AS 109. What are the typical type of complex financial instruments? What are the inputs that are required in complex financial instruments? And then we are going to take some real life studies, for example, like a cross currency swap, an ESOP, a management stock option scheme, and we can also use a waterfall mechanism, OPM backstall method and all. So we'll just try to see that how in the real world the complexity is there. And why I am telling you this is very critical for each of us to learn is that from a very practical perspective, this part of the pyramid, although the volume is very high, where you have these RV reports, etc., but the competition is also very high. You have just too many players here. The moment we graduate our skills to the next level, we will find that it is far easier for us to get hold of complex assignments, which are more remunerative in nature also, and where competition is less. So if you look at what are the kind of instruments which come into the category of complex instruments. So there could be debenture valuations. Now, debenture valuation is a very complex task. Specifically, if it is like a non-convertible debenture, it is mostly like you can take a view that it is a debt in nature. However, if it's an optionally convertible debenture or a fully convertible debenture, again, it is a fully convertible debenture at whose option? So for example, there could be a call option in it and there could be a put option in it. What does this mean? That if it is convertible at the option of the issuer, that's a separate story. If it is convertible at the option of the buyer, the lender basically, then that's a separate story. So when you have an optionally convertible or a fully convertible option, there is a Black-Scholes model that can be applied here to kind of quantify how this option can be valued. And to that extent, that option value will be shown as a contingent liability in the issuer's books of accounts, because at any point of time, say, let's say after a particular period, the lender has, let's say, the option to call and convert those preference shares into equity. So that kind of becomes an embedded option into that whole thing. And you can have a fully convertible option. That's one. Similarly, you have warrants. Warrants and loans will be different again because of the term sheets that are associated. And various other derivative valuations could be there. There could be hybrid instruments. What is the best example of a hybrid instrument? We have the CCPS. So compulsorily convertible preference share is a very good example of a hybrid instrument where, depending on again the clauses of the term sheet, you will find that there is an element of equity and there is an element of debt in the whole thing. So how do you value CCPS? That is a very interesting thing. And we will take an example of how, if in a capital structure of a company, you have preference share capital as well as equity share capital and options as well. In that case, how do you allocate the whole enterprise value amongst the different classes? Okay. So from that perspective, a CCPS valuation could be one thing that we should actually emphasize towards this session. Similarly, there could be financial liabilities in terms of different for example, you have a corporate guarantee which needs to be valued. That is an interesting thing. So preferred stock like CCPS that we were talking, and so how that will be done for tax, how it will be done for financial reporting. So in financial reporting also, if the company has Ind AS implemented, then they will have to look at exactly the clauses of the term sheet, the liquidation preference, the conversion ratios, etc. at conversion price, and accordingly. So because why? Because the CCPS essentially is a debt instrument, but it has an embedded option in it that it can be converted into equity 5 years from now at a particular conversion price. So hence it is potential equity. Now, how do we as valuers take a view that how much of that whole amount of CCPS is debt and how much of it is equity is where the whole calculation comes into the picture. Because it's an option, the conversion price can vary. That conversion price can be contingent upon certain events. For example, if the EBITDA of the company is 4% and above, then it will be this. And if it is 6% and above, then it will be this. So from that perspective, you will have to figure out how this whole thing can be done. That's one thing. And then you have the CDS contract. So one very interesting thing is from a forex hedging perspective, companies have a lot of hedging instruments. So there could be like a future, there could be an option, or there could be a forward, right? These are the typical things through which companies hedge the foreign currency risk. So what is a foreign currency risk for the uninitiated? For example, if I'm Infosys and I have exported services worth $1 million to my client in the US, the dollars are going to come into my account 3 months from now. Now, how do I hedge that risk of a dollar falling, the rupee dollar rate falling from 82 or 83 to 18 3 months from now? I can take a plain vanilla forward and say that, okay, I have sold this thing 3 months from now at $82, 82 rupees to a dollar. That can be through a future, that can be through an option. Now, look at it from a different perspective. If I'm a company and I have, for example, taken a ECB, external commercial borrowing. So this ECB basically means that I have raised amount in USD. Once I have raised an amount in USD, what is going to happen is that I have to repay dollars both in the principal repayment as well as in the interest repayment. Now, what I can do here is that I can actually enter into a swap. I can enter into a swap with the particular user of the bank, for example. So here what is going to happen is, I am just giving you a background to it. Once we look at the maths of it, it will be even better. So for example, if I am a company and I have a lender. So the lender has, let's say, given me 500 million USD today. What is going to happen? I have to pay back the lender in 5 equal installments, $100 million in each of the years. Plus, I have to pay to the lender Libor plus, let's say, 200 basis points of interest. So that's my coupon. Okay. Now, what I can do is that I can go to a bank and say that, look, bank, I don't want to have this liability open in my books. That in terms of the rupee dollar fluctuation, it can become very messy in terms of my books. So what I'm going to do is that every year, whenever this liability comes, I am locking the exchange rate at 82. INR USD rate is 82. So you give me $100 million as a bank, and I will give you the multiplied by 82 rupees. Similarly, for the interest, I can have an exchange thing. Now that's okay. That's a commercial transaction. Now for me, what happens is that once this swap is there, this swap has to be brought into the books by doing mark to market. Why? Because this rate which is locked today, for example, in 2023, when I have raised the loan, this rate is locked. Now 2024, 2025, 2026, 2027 and 2028. For these 5 years, I will have to repay the rates. Now this will not, because of the natural interest rate parity, what is going to happen? There is an expected depreciation that is there in the rupee to USD, and therefore there will be something called a mark to market. Now, we will look at it that this mark to market gain or loss as a financial instrument as per India's 109, what you can do is that you can either charge it to PNL, you can make it as a fair value through PNL, or you can also route it through the OCI. So from that perspective, one, it is very important for someone to understand that what is the criteria for which the instrument will be either fair value through PNL or it will be OCI. And then how do you do the hedge effectiveness test? And from that perspective, we will look at that. And yeah, so coming back to our presentation, what we will have to look at is that what are the inputs that are required for these particular things. So there's a lot of guidance which is given under India's 109 as far as this valuation is concerned. There are debt instruments as per FIMDA guidelines. Okay. So basically what happens is that you can have a closed form Black-Scholes model. You can have binomial lattice models customized to capture key features such as the exercise option. What you can also do is that you can have Monte Carlo simulations. So I will actually take you through a Monte Carlo simulation also, where what you can do is that you can incorporate performance as on and or market conditions or other complexities in the analysis. So just think of it like I am a startup, and as a founder of that startup, someone expects that, okay, if he or she takes the company's performance to a particular level, then what is required is that they will want that, okay, if the valuation of the company becomes this, then I will get this much number of shares. If the EBITDA of the company crosses 6%, then I will get this much number of shares. Now, how do you actually know that whether the EBITDA of the company will be 6%, 5% or not? You are not sure. So as a valuer, how do you value that management stock option, which is like a performance linked management option? Now, again, there is a thing that in Companies Act, it is not possible that you can issue equity to someone conditional upon performance. You can only do ESOP. Now, ESOP is a different variant because in ESOP, what happens is that it is only passage of time, which is the criteria for an employee to get the shares vested into his or her account. But in case of management stock options, where we are looking at MSOP, what happens is that management stock option is compared to ESOP is a more complex thing where it is incorporating performance related obligations and other complexities, that what if the company is going for an IPO or not. Now that can be a very critical thing, that how can you value this particular aspect, that what is the probability of the company actually getting into an IPO. And what you can do there is that maybe you can take a historical analysis that, okay, if this company is in the D2C space, how many companies have raised Series C so far in this? Like this company, for example, if this company has also raised a Series C round, so how many other companies in the D2C space, in the equivalent space, have raised a Series C round, and how many of them have come into an IPO? And accordingly, you can kind of run a Monte Carlo simulation and see that what is the probability of this company also getting an IPO. And accordingly, there will be a probability that will be assigned to this IPO event. And therefore, the stock compensation expense, which we as a valuer have to give to the company for the P&L accounting, will be certified. There can be backsolve model to derive the value of the common stock with the benchmarking of the preferred stock. Now, this is something which, as a mistake, a lot of people practicing valuation do. That what they do is that in the cap table, if there is both common stock as well as preferred stock, what they do is that they assume that, okay, the conversion ratio is 1:1. So CCPS, 100 CCPS is equivalent to 100 equity shares. Is that a correct understanding? No, it is not. Why? Because CCPS as an instrument is far more superior as compared to the equity instrument because of liquidation rights, because of anti-dilutive clause, because of voting power, etc. So from that perspective, you actually need to have a backsolve model to understand that how do you derive the value of the common stock benchmarking with the help of the preferred stock. See, why? Because as far as the standard is concerned, we have 3 levels of inputs: level 1, level 2, and level 3, where level 1 is a market rate. Now, what happens is that, let's say the startup has recently issued to investors CCPS. So the price at which, let's say the CCPS is 1050 rupees per CCPS is the price at which the CCPS has been issued. How do I actually value so this becomes a level 1 input for us, because as per the market participants, this is the most objective valuation metric that we have, rather than using a comparable approach or using an internal approach, like based on management projections, you use an income approach. The best thing, because an external person has invested in the company in the form of CCPS at 1050. But for my option pricing model, in my Black-Scholes model, I have to put in equity value. Now, will equity value also be 1:1, so 1050 rupees? Of course not. Because if there is on the cap table a CCPS, and it's a very dangerous clause in terms of CCPS having this liquidation preference, etc., means that if the company gets into liquidation, the first proceeds of that liquidation will come to the preference shareholders, the CCPS holders. Equity comes very last in that whole pecking order. And therefore, if you have an enterprise value which needs to be allocated among the different classes, there's a whole method to that. And accordingly, you will find that equity will be, in our judgment cases, it is at least 20% lower than the price at which CCPS is issued. So, for example, if CCPS is issued at 1050, you will find that through the option pricing model, the Black-Scholes model, you will find that the equivalent equity price will somewhere around 830, 840. So that is something which is interesting, which should be learned. In terms of the first decision that needs to be done while we are doing the valuation is to look at, whether it is a debt or equity. Is that if it's, let's say, debt, are cash flows solely payments of principal and interest? Yes. Then what the standard says is that you need to assess the business model. And what is the business model basically means that this business model says that what we will do is that, yes. So what is going to happen is that what you need to assess is the business model. And then there are 3 criteria: hold to collect and sell, and hold to sell. And depending on that, you will have to value it at amortized cost, fair value through OCI, so other comprehensive income. The advantage of routing things through OCI is that the fluctuations in terms of mark to market will not hit your P&L. So your P&L will be far less volatile. Okay, and then you have a fair value through a P&L where the cash flows, are they sole payments of principal and interest? No. And then in equity, where there is a fair value through OCI option, irrevocable choice by instrument, depending on whether it is yes or no, it will be either fair value through P&L or fair value through OCI and equity. So if the financial asset debt is measured as fair value through OCI, all the movements in the fair value will be taken through OCI, except for the recognition of impairment gains or losses, or interest revenue using effective interest rate, which is the EIR method, a very famous method, and forex gains or losses, which are recognized in the P&L. But broadly, what is going to happen is that all the mark to market gains losses which happen, they will be part of the OCI. So that is one call that we need to take as valuers, that whether it is a OCI. In fact, this is not the call which is taken by the valuer. This is the call taken by the company's management. At the very inception of the contract, depending on how they interpret the conditions which are recognized in India as 109. So when you recognize the financial instrument, depending on the contractual provisions of the instrument, you will have to decide how that classification happens. And then there is a criteria for derecognition of the financial assets also, when the contractual rights to the cash flows expire and the entity transfers the financial assets and the risk reward of the ownership. This is broad theory, but the point is that depending at the very inception of the financial instrument. So for example, if when this foreign currency swap had happened, so you were not the valuer of the company. At that point of time, someone else took a call that this will be routed through OCI. Now at the middle, you cannot really say that, okay, I will take a different view, unless there's a glaring mistake there. So that is something that you need to understand, that this is at the very beginning, that based on the contractual provisions of the instrument, you recognize the financial instrument. How do you classify the financial instrument? So the contractual cash flows, are they solely for principal and interest? Yes or no. No, then it is an equity instrument, fair value through OCI option selected. Okay. Yes or no, depending on that, again, it will be either if it is no, then it will be fair value through PNL. If it is yes, then it is fair value through OCI. I personally feel that a lot of this volatility should be captured through fair value through OCI, because fair value through PNL kind of makes the PNL more volatile. Now then, if it is a contractual cash flow solely for principal and interest, then the second thing that we have to check is that in terms of the business model, is it only a held to collect contractual cash flow only? Yes. And then has the entity exercised the fair value through PNL? Yes. Then it will be fair value through PNL. Otherwise, it is going to be amortized cost. And if it does not meet the business model criteria, then you'll have to check that, okay, it is to held to collect contractual cash flows and for sale. Yes. And if it has used FTPL, then it will be here. Otherwise, it will be through OCI. So fairly complex flowchart. So, but depending on the typical nuances of that particular contract, you will eventually find that that instrument as per Ind AS 109 will be either amortized cost, or it will be fair value through PNL, or it will be fair value through OCI. So the initial instrument of measurement of the financial instrument will be at fair value, and therefore the role of the valuers comes that all financial instruments have to be measured at fair value through PNL, and they could be like a fair value plus transaction cost, where all other financial instruments at amortized cost or at other value through OCI, they are measured. And how is the subsequent measurement happening? Financial assets plus financial liabilities at fair value or at amortized cost. So if it is at fair value, again, so for example, if I have a cross currency swap, a CCPS, I have two options where I can make it like a fair value through PNL, or I can make a fair value through OCI. So if it is a fair value through PNL, what happens is that the quarter on quarter fluctuations in the gain, in the valuation of the assets, that is a swap or the financial instrument, will be marked through the PNL, or otherwise it will be marked through the OCI. So that is something that you as a valuer you need to do. Now this is one thing as far as the guarantees is concerned. Now valuation of guarantee has also become a very complex thing, that how do you value guarantee. Now very interestingly, GST department has reiterated that it is just 1% of the amount of guarantee option or actual consideration, whichever is higher. So if company A has given a loan to company B and company C gives a guarantee to company B, that boss, you give a loan to company B, but I will give a guarantee that if this company B defaults, I will pay. Now, this is essentially a transaction between entity C and entity B. Now, how do you value this financial guarantee is again something which as valuers falls into the category of complex financial instruments. So what we need to do here is to understand that, okay, where are we really headed in terms of the contractual cash flows which are there. Okay. So that is, we will look at this. Now, what is derivatives? Basically, a derivative is a financial instrument or other contract with the following characteristics. Its value changes with response to the underlying. It requires no or initial investment, and it can be settled at a future state. So, for example, if we had that cash flow modeling where the bank would give me a fixed stream of dollars and I would give the bank a fixed stream of INR. Is that a derivative? Yes, of course it is derivative, because its value changes in response to the underlying. So for example, if I have a right to receive, this is me and which is the bank, and if I have the right to receive from the bank INR 80 per USD 82, example, if the today's prevailing rate becomes 82, then what happens is that I have a mark to market gain of rupees 2. Okay. So its value changes in response to the underlying, because had this contract not been there, I would have purchased dollars from the market. I would have to pay 84 rupees. But now, because I have this interest rate swap and the principal swap, principal only swap, IOS and POS, as they call it, interest only swap and principal only swap, and sometimes it is both. Now there's a mark to market gain in my books because the underlying has moved to 84, whereas I continue to have the option to have the dollars at 82 instead of whatever we. So for example, if now I have to pay to the bank 82 to get these dollars, if at 80 rupees I have, that's the mark to market, so then I have a MTM loss of rupees 2. So from that perspective, on a quarter to quarter basis, if you have, let's say, an interest rate swap into the books, IRS, or a cross currency swap, or a future, or a forward, or an option, all of these derivatives will have to be marked to market on a quarterly or a half yearly basis, depending. For example, a lot of companies take the view that they are listed, they are supposed to give the balance sheet at 6 months. So the June quarter and the December quarter, they don't give this mark to market. And so they don't get into this exercise only of doing the mark to market of the cross currency swaps, etc. So this is the definition of derivatives, and this is how it is done. Financial instruments could be basically a contract which results in a financial assets for one entity and a liability for the other entity. And we therefore, when you talk about complex financial instruments, what is the meaning of that? If K Limited invest in debentures of T Limited or in shares of T Limited, so then this becomes a liability for T and an asset for K. Now both of them therefore will have to value these financial instruments in their books, K Limited as a financial asset and T Limited as a financial liability. So financial assets could be different thing, a cash, an equity instrument of, so for example, I have shares of that company, if I have debentures of that company. Okay, so all of these I'll have to then recognize as in my books. Contractual right to exchange fixed assets or financial liabilities with another entity that is potentially favorable to the entity. So for example, if there's a cross currency swap, so for me, it is an asset because it kind of puts me in a much better favorable position with respect to forex exchange fluctuations. So that's the financial assets that needs to be recognized in the books of accounts. For example, K Limited is an Indian company which exports goods to the US. It expects to receive $1 lakh in 3 months' time from these sales. However, it is concerned that USD prices can fluctuate, they can fall. So it enters into a contract with the bank to sell $1 lakh in 3 months' time. And the agreed rate, let's say, is 50 rupees. So after 3 months, if the spot rate is less than 50, which means the conditions are potentially favorable to K, that is what we had discussed. So in this way, had K Limited not entered into this contract, it would have sold $1 lakh at a lesser rate for conversion into INR. And hence the contract is potentially favorable to K Limited and therefore a financial asset. So that is something that you need to understand. And the contract that will or may be settled in the equity's own instrument is also a financial asset. Or non-derivative is where an entity may be obliged to receive a variable number of its own equity instruments. Or K Limited, for example, K Limited enters into a contract to buy its own shares for 1 million in 3 months' time. So the number of shares is determined by the prevailing market price there. Or a derivative that will or may be settled other than by exchange of a fixed amount. For example, if they say that there's, for example, a streaming contract that I will buy my 1000 shares by giving you 500 grams of gold. For example, if I'm a gold miner, I'll give you 500 grams of gold and in return, I will buy back my 100,000 shares. So in this case, the current price of 500 grams of gold equals 1000 shares. Now, suppose if this price change of the gold, then what will happen is that because the number of shares remains the same, then there will again be a financial assets and therefore a fluctuation in terms of the mark to market value plus or minus. And the contrary is the financial liability. So what is financial asset for one entity becomes a financial liability for the other entity. So how do you classify this under IFRS also? Amortized cost, an asset other than a financial instrument that meets the below conditions, held within a business model whose objective is to hold the asset in order to collect the contractual cash flows. The contractual cash flows of the financial asset give rise to cash flows on specific days that are solely payments of principal or interest on the principal amount outstanding. So for example, the CCS, the cross currency swap, where we had an external commercial borrowing, it's a classic example of these conditions being met. that you can also choose that, okay, I will do it at amortized cost, because whatever is the asset that is held in the entity, the contractual cash flows are solely payments of principal interest on the principal amount outstanding. Or you can do it on fair value. So the typical thing here is, what is the financial business model of the entity? That is something for which is very critical for us to understand. Unless we get into that, the classification between amortized cost, fair value through P&L, and OCI will not be able to be done. So this is as far as the basic theory was concerned. Now what I will try to do is that I will give you some sense on how do you do valuation of a cross currency swap. Now what happens in a cross currency swap is that, let's say I have an entity where these are the days where it is supposed to receive, it has to actually pay to the third party principal repayments of, let's say, Singaporean dollars. Okay. Now from that perspective, what needs to be done is that, it's a very interesting thing. You please understand here that what is going to happen is that this is my client. My client has to pay to the lender on each of these days this much Singapore dollars. And it also has to pay the interest also to them. Now, since it is Singaporean dollar, the client also entered into a back-to-back contract with the bank and said that, boss, I will pay you INR only. You pay me Singaporean dollar, and that net I will pass on to the lender, and my liability will remain in INR only. This will remain for principal as well as for the interest. Now, how do you actually value this in the books is a very interesting exercise. That is something which is actually some sort of a specialization. So what happens here is that you will say that today the spot price as on 30th September, Singaporean rupee is 60.60, because you can just go to Bloomberg and you can take the calculation here that what was the high, what is the low, and you can say that, okay, the average of the high and low, if you don't have the closing price, this is the closing price. Now, from the Bloomberg screen only, what you can do is that you can get, there are different sources. You will get the forward premium for 31st December 23, 31st March 24, 30th June 24, 30 September 24, etc., where you will have different forward premiums. So what you can do therefore is that now you need the forward premiums up to 30th June 26. Mostly on the Bloomberg screen, you will get like 3-4 quarters, you will get the forward premiums. So from that perspective, what is the best thing to do is that you can then say that, okay, in the last up to September 24, what is the amount? It is 2 rupees 20 paisa, which is the forward premium, which means what? That today, if it is 60 rupees 60 paisa, in 2 years from now, this will become plus 2 rupees. So it will be, for example, 60 rupees 60 paisa plus 2 rupees 20 paisa is equal to 62 rupees 80 paisa. And now, therefore, in each of these, what you can do is that you can add 0.5555 and try to get what is the implied Singapore dollar SGD INR rate. That is a very critical thing, because this data is not readily available, like, because these are basically OTC, over the counter, as compared to something which is readily quoted on the markets. So there are two methods to get these quotes. So for example, you can tell the bank that, okay, boss, just give me some. So this is the spot as on 30th September, 60 rupees 72 paisa. And what is the forward premium for each of these periods up to my 30th September 2023? SGD INR is the currency pair. Now, so therefore, what I get is the outright. If I were to enter into a forward contract, bank will say that, okay, the spot is 60 rupees 72 paisa, and there's a premium of 54 paisa, 1 rupees 11 paisa, 1 rupees 70 paisa, 2 rupees 24 paisa, etc., going forward in each of the periods. So therefore, the forward premium is this. In some cases, you will get something called OIS, overnight interest swap, from where you will again get the bid ask spread and get this whole thing, that how much is the this is also important from the discount rate perspective, that how you will discount that. We will see that later. So you have like a MIFOR for 1 month, 2 month, 3 month, 4 month, 5 month, that you will need to also get from the market. So what you need to do here is that you have the right to receive $11,15,000 from the bank on 29th December 2023. Let's say 3 months from now. The forward rate is 60 rupees, 61 rupees 66 paisa, because that's the forward premium. So how much INR you will have to pay, which will actually need to be pay if you were to enter into a contract today. So for example, if you were to enter into a contract today with the bank, that 3 months from now, I will need $11,15,000. The bank will say that, boss, the forward rate will be 61 rupees 26 paisa, depending, because of this forward premium, and this is the INR that you have to pay. And hence, as per my swap, I'm very happy that I have already fixed that for this 1.1 million Singapore dollar, I have to pay only 60.8 million INR. If I were to now go into the market and ask, then what will happen is that I have to pay 68.3 million. Similarly, for the next quarter, March 24 quarter, I will have to, because the forward rates are going to keep increasing, I have to pay the INR, which is this multiplied by this will be the INR to be paid. But under the swap, I am fairly happy that I have to pay only 60 million. Okay, so 60 million, 81 lakhs. No, so this is how much INR to be paid is, yes, 6 crore, 8 lakhs, 18,027. So what is the fair value of the swap? Simple mathematics. How much would I actually have to pay if I were to actually enter into this contract today, minus how much I have to be paying under this swap. So from that perspective, the fair value of the swap, as far as the principal is concerned, becomes a very positive thing for me, right? So that becomes, so for example, here I have an 11 crore 98 lakh rupees gain under this whole thing because of the fair value of the swap being this. So I am able to get this. Now the interest to be paid in the INR. Now this is as far as the principal was concerned, I used this. Okay. Now the other option that will be there will be the interest also has to be done. So if you look at the contractual conditions, what they say is that the INR interest to be paid here is how much? The total INR that I'll have to pay into 90 by 365 multiplied by 7.05. So what is happening here is also that I tell the bank that, boss, I don't want to again remain open on the exchange rate front with respect to my interest payments. So I will pay you 7.05 as an interest rate which is outstanding on the total contractual obligations that you have. So I have basically converted my external commercial borrowing into a series of INR repayments to the bank. And hence, for all practical purposes, my loan is basically these series of payments which I have to make to the bank. And therefore, the interest that I have to pay to the bank will be this whole series multiplied by 7.05% into 90 divided by 365. And similarly, this will be this whole series into 92 divided by 365. And so that is how it will be, the interest to be paid. Now, Singaporean dollar interest to be received. Now, that is very interesting. That will be done in the Singaporean dollar and the interest rates will be 1.58. And hence, what is going to happen and what is the INR equivalent of that? The INR equivalent of that will be the forward rate. So if I were to enter into a contractual liability, I will say that, okay, 1.58% interest. And today, if I were to book it, it will again get converted into this forward rate that is there. So into 3D5. Okay. So here also, for example, if it is this whole thing, Singaporean dollar, into 94 by 365 into this particular exchange rate multiplied by 1.58%. Okay. So from that perspective, what I have to do is that now you see that basically what is happening is that the bank also is not like they are also doing business, right? So they are giving you such a huge gain, but what is happening is that they are making you pay 7.05% interest in INR and they are taking on the exchange rate risk. So what is happening is that they are gaining in terms of the interest rate payments. So as far as the fair value of the swap for the interest component is concerned, what you will see is that it is the difference of these two payments, that what you were supposed to pay actually as per the contract, and had you entered into the contract today based on the remaining amount which is outstanding in the Singaporean dollars at that interest rate into the days by 360 and multiplied by the forward rate, how much which you have to pay. That is a very important thing that we need to understand here. So then that is something is the critical thing. Fair value of the swap principal, fair value of the swap interest, and therefore what is the total which is there for each of these periods. Okay, that is the first part. Now you remember that we had also taken the discounting rate, which is how we had taken this. We had taken the overnight interest rate swap, OIS. So based on the OIS that we had, what we also do is that, okay, this is my discounting rate, 7.48%. And hence, what is the present value of the swap? Because this is the gain that will accrue to me at 3 months from now. This is the gain that will accrue to me 6 months from now, 9 months from now, like that. The discounting rate, depending on the tenure of the OIS, I have different rates. So here I have these OISs. So for 3 months, it is 7.48 here. You can see that 7.4821. This is a Cogenis Bank my for 3 months. And hence here I have used 7.4821%. So what is the present value factor for me here? It is this minus this by this. And therefore, the discounting factor is that is simple maths. So it is basically 1 divided by, so the whole concept is 1 divided by 1 plus r to the power n, where r is the overnight interest rate swap for the period and n is like 90 days, 92, 180 days, etc. that I will have to do. One divided by 1 plus n6. So n6 is this discounting rate to the power O6. What is O6? It is the present value factor. So how do you derive at the present value factor? It is basically what is the date as on. So what is the formula here? It is the date like 28th March 24 minus today's date. Whatever is the difference, that is the number of days. And accordingly, that becomes the n. Okay. So the present value factor is this minus this divided by 365. So you see this minus this. So I have done 30th September 2025 minus 30th September 2023, which is my today's date, and divide by 365. And therefore, I arrive at my discounting factor. And therefore, the discounted fair value of the swap for me becomes this total amount I had done, which is the principal plus the interest. I multiplied it by the discounting factor and I got the discounted fair value of the swap. So therefore, I see that, okay, the fair value of the swap for me here is 5 crore 80 lakhs 90,380, 95,318. What I also need to do is whether there is hedge effectiveness in this, because unless there is hedge effectiveness, I will not be able to account that for through the OCI. So how do I account for it as per the hedge effectiveness? So what if everything else remains the constant? My exchange rate moves up by 5%. Will I still remain effective here? So if instead of 60.60, what if the interest rate becomes, so this is what basically it is 60.6 into 105%. So it becomes 63.63. Other things in the contract remain the same in the workings, but my mark to market changes substantially. Why? Because if the INR Singapore pair becomes 63.363 instead of 60 something, what will happen is that the fair value of the principal component of the swap becomes very high. But what is going to happen is that the interest, I will have to see that whether that will change. Okay. And whatever happens, so what will happen is that instead of plugging the spot rate of 60 point something, I will put like 63.63. And accordingly, I have the interest rate to be paid and the fair value of this swap. And here also I have the fair value of the swap for the principal. So I have the total amount. I multiply by the discounting rate, the present value, and I get the discounting factor and the discounted value of the swap. What if it is minus 5%? So what will happen? If the spot rate becomes 57.57, the fair value of the swap becomes very less. So because where I had a gain of 11 crores 98 lakhs, my gain will be only 8 crores 3 lakhs. And here the gain is like 15 crores 92 lakhs. So what will happen is that where the fair value of the swap was 5 crore 80 lakhs, here the fair value of the swap had become 9 crore 43 lakhs if the spot rate had gone up to 63.63. And if the spot rate fell down to 57.57, then would have happened the discounted fair value of the swap becomes 2.18 crores. So what is hedge effectiveness here? If instead of 60.60, the spot rate becomes 5% higher or the spot rate becomes 5% lower, how much is the net value of the swap? And then what is the difference between the two pairs? And accordingly, how much is the difference that I have to also pay? And you see that if the change in value for plus 5% is 3 crore 62 lakhs, the change in value for minus 5% is also 3.62 lakhs. So how much is the percentage of hedge effectiveness? It is this by this. So my hedge effectiveness is 100%. The moment it becomes 100%, then I can route it through my OCI. So I can just show you the literature for this, that I'm just taking it out from a real report. Yeah. So what I can do here is that I will have to do the hedge effectiveness testing here, where the object of hedge accounting is to represent in the financial statement the effect of an entity's risk management activities that use financial instruments to manage exposure arising from forex risk. Okay. So where the entity has elected to present changes in fair value in OCI. So that's the whole thing. That if you have chosen to present it in OCI as per the para 5.7.5 of the Ind AS 109, then the hedge mechanism has to be very clearly articulated. So the object of the cross currency swap, of the interest rate swap, is to hedge the cash flows of the foreign currency denominated debt to related in variation. So this is a basically forex rate. So the hedge provides for exchange of notional amount at agreed exchange rate of principal as well as interest rate at an agreed exchange rate. So the company is following hedge accounting for cross currency and interest rate swaps based on qualitative approach. And this risk management is there. So the company assesses hedge effectiveness on the following criteria. Is there an economic relationship between the hedged item and the hedging instrument? Yes, because it is all based on foreign exchange fluctuations. What is the effect of credit risk here? And what is the assessment of hedge ratio? So the company designates cross-currency swaps and interest rate swaps and some foreign currency forward contracts to hedge its currency and exchange rate risk and applies hedge ratio of 1:1. So what is the qualifying item? As per Ind AS 109, it can be either a recognized asset or a liability or an unrecognized firm commitment, a forecast transaction, or a net investment in a foreign. In our case, it is what is that? It is a stream of Singapore dollar cash flows, which were derived based on the highly probable cash flows that I will repay foreign currency loan, which I am proposing to be drawn. So I had done this designation at the very beginning of the contract. Right? So what is my hedging instrument? It is a cross currency swap denominated in Singapore dollar INR, where the company pays fixed interest on the INR notional and receives fixed SGD interest derived based on the swap contract. It pays INR notional and receives SGD notional of the CCS. So critical terms of the swap contract, tenor and SGD notional match with the hedged item. So cash inflows on the receive leg of the hedging instrument match with the interest and interest paid on the SGD denominated Singapore loan. So as far as I'm able to match the cash flows, the loan will be drawn from the date in which the swap becomes effective. So I'm kind of matching and ensuring that I'm fairly effective. So if you look at from an analogy perspective, that I'm walking in the rain, but I have a complete raincoat. So I am fully hedged as far as the rain is concerned. So hedge effectiveness is the extent to which the changes in the cash flows fair value or the cash flows of the hedging instrument offset the changes in fair value of the hedged item. So as long as the spot rate changes by 5% and the value of my swap also changes by 5%, then what happens? It is an effective thing. So what is the criteria for determining hedge effectiveness? Economic relationship. Credit risk does not denominate the value changes because my counterparty is a sovereign bank, for example, State Bank of India, and the hedging relationship is expected to be highly effective in achieving the stated risk management objective. So what is the basis of the hedge effectiveness testing? It is A by B, where A is the change in value of the hedging instrument and B is the change in the value of the hedged item. So once it is A by B, then I will be able to go for the hedge accounting and hence I can route it through OCI. So there is an economic relationship. Hedging instrument and the hedged items have values that move in the opposite direction because of the same risk. So if my spot moves up by 5%, as far as the loan mark to market is concerned, there's a loss, but I gain in terms of the swap because I've already hedged that. So whatever I lose in terms of the mark to market of the loan, I gain in terms of the mark to market of the swap, which is the hedge risk. Hence, there must be an expectation that the value of the hedge instrument and the value of the hedged item will systematically change in response to the movements in either the same underlying that are economically related in a similar way or the risk that is being hedged. So here what we have done is that whatever was the cash flows of the hedged item and the hedging instruments, we found them to be matching because moment 5% fluctuation happened. My loan also moved by 5% and my the fair value of the swap also moved by 5%. And credit risk is if there is an economic relationship between and if there is a credit risk, for example, the counterparty, if it is a large bank, so then there is no substantial credit risk. Now, State Bank of India is not going to declare insolvency of it because it is not going to able to honor a 2-3 million mark to market loss or gain mark to market loss. So credit risk that thing has to be very clear that the credit risk does not dominate the value changes from the economic relationship between the hedged item and the hedging instrument. And the hedge ratio here is basically that 100% that he calculated. And this is the proposed effectiveness testing. What we did was the prospective testing was done using dollar offset method, where we gave a shock to the spot rate. What we did was we gave a shock of 5% increase in the exchange rate and 5% decrease in the exchange rate as on the valuation date. And since the hedge effectiveness was 100%, we said that the hedge is prospectively fully effective. So this was as far as the cross currency swap is concerned. And if you look at how companies disclose that in their books of accounts also, that will kind of close the whole loop. So let's say we'll pick up any company like a Tata Steel, and you will see that it will talk about hedge effectiveness. So it will say that, okay, derivative instruments and hedge accounting. In the ordinary course of business, the company uses certain derivative instruments to reduce business risk that arise from exposure to forex and interest rate fluctuation. These instruments are confined to forwarded contracts, cross currency swap, interest rate swap, and collars. These instruments are employed as hedges of transactions included in the financial statements or for highly probable forecast transactions. For example, an Infosys or Wipro, they can get into even a contract for dollar receivable that has not really become receivable, but they are sure that, or it's very highly probable that that will happen. So these derivative contracts do not extend beyond 6 months, except for certain currency swaps or interest derivatives. So they are accounted at fair value as on the date of the derivative contract and subsequently remeasured to their fair value as on each reporting date. So this is very important that they are remeasured to fair value as on each reporting date. The company adopts hedge accounting for foreign forward exchange rate and interest rate contracts. So at the inception of the hedge, there is a formal documented designation of the hedging relationship. Key, what is the hedged item, the transaction nature of the risk being hedged. At the inception, the hedge is expected to be highly effective, which we check like in our cases. The offset happens at the fair value attributable to the hedge risk, the offset is happening. The effectiveness of the hedge instruments to reduce the risk associated with the exposure is assessed, measured at the inception, and the ineffective portion of the designated hedge is recognized immediately in the P&L. So only the effective portion, it will be measured in the OCI and remeasured also, and whatever is the gain loss will go into the OCI. But the ineffective part will go into the statement of P&L. So whether when the hedge accounting is applied for fair value hedges of the recognized assets, the change in fair value of the hedged assets and liabilities attributable to the risk being hedged are recognized in the statement of P&L and compensate for the effective portion in the symmetric nature of the fair value of the derivatives. But as far as what we have discussed right now is a cash flow hedge. So the effective portion of the changes in fair value is recognized directly in other comprehensive income, and the ineffective portion is recognized in the statement of P&L. So this is something that is very critical for us, that as far as hedge effectiveness is 100%, whatever is the mark to market gain or loss, we can book that in the OCI. So let's say if it was like 90% effective, then 10% of the mark to market gain or loss would be booked in the P&L, and rest, the theory you can read on your own subsequently if you are finding this to be of interest. So this is the first component which I wanted to cover today, which was the interest rate swap. Now what we will cover is the other option which we have is the option pricing model, which we wanted to understand. Now, as far as the option Black-Scholes model is concerned, so while it is very simple, I mean, it does not even merit someone to spend time to understand, because what you can realize is that there are n number of seminars which are conducted on Black-Scholes model, and there is nothing like, there are online calculators which are available for Black-Scholes model. Now, the thing is that in Black-Scholes model, there is a date of grant, the date of valuation of the underlying asset. So whenever you grant the options, that's the grade of the option. So when you grant an option to the employee, company to the employee, what is an option? That boss, there is a vesting period of 1 year. And then once it vests, so we are at year 0, 1 year to you will have to remain in the company and wait. Be a loyal employee. That's the vesting period. So then you get the right to exercise these shares. Again, that's an option. So how do you value that option? It is an financial instrument. because you have given a call option to someone that they have the right to buy your equity shares. At what price can they buy your equity shares? They can buy it at $0.13 per share. What is the vesting period? 1 year they'll have to wait, and after 1 year, then another 5 years. So this 5 year window, this will be an exercise period for them. That at any point during these 5 years, they can actually exercise the option. So the exercise period is 5 years. And so therefore, what is the time to maturity? It is 50% of this 5 period. So the minimum is 1 year. The maximum is 6 years. So what is the average? 1 plus 6 by 2 is equal to 3.5. Now that is one input that goes into the Black-Scholes model. The other option that comes here is that what is the historical volatility here? Okay. So as far as historic volatility is concerned, there could be like, what you can do is that, let's say this is an IT company. So what I can do is that I can go and see that who are the comparable 5 companies in the IT space, and I can look at the volatility of their share prices. Or the other option is to go to Ashwath Damodaran's website and try to get that data in terms of volatility. So as far as the volatility of comparable companies is concerned, how that is calculated also, let me show you. So what we do is that we take, let's say because the tenure of the option is 5 years, 3.5. So the maximum tenure is 5 years here. So what we do is that 30th June 22, let's say, is the date of valuation of the option. What I will do is that I will take the stock price data for 5 years here. And in fact, more. So let's say if it is 7 years or something, I will take like that. Okay, till June 16, I have taken. So what I can do is that every day I have a closing price. So my natural log of the price change is this by this. In each of the date, this is today's closing price divided by yesterday's closing price. Today's closing price by yesterday. And this is, we have to use the log function, natural log of the price change. And then therefore, what is the standard deviation? You have to look at like the stdiv dot p of this whole thing, or the rolling period you can take. Like this is what I have done is that rolling 1 year returns I have taken. Okay. So what I can do is that stdev dot p and into square root of 248. So that becomes the annualized thing. And then what I can do is that standard deviation, that's on a rolling basis. And here I have calculated again like this. And what I have done is that that's into square root of 252. So I have calculated this for, let's say, Sonata, Coforge, Persistent, Emphasis, First Source. How do you get this data? This you can get on the NSE website, where you can just go to NSE. And you can just go and click like what is Coforge. And here you will be able to get the historical data for the company for each of the days, and you can export that as a CSV. You can keep changing the dates and you will get this. So now the first thing therefore is, so just the addendum to this is that if I have taken the stock price as on the given date as 92.6, but if the company has actually issued CCPS, then what? Can I take like, a view that, okay, if the CCPS has issued at 105, so equity is also 105? No. So what I wanted to show you was that in such cases where CCPS and equity both is there on the cap table, what one should do is that we should be able to allocate the enterprise value between the different classes of entities which are there on my cap table. So what I will have to do is that I can do a option pricing mechanism, OPM. And what I can do here is Just opening. Yes. So what I do here is that first of all, I can do a WACC calculation of the company to arrive at the equity value. So just understanding that very quickly. So I have, for example, if this is a company in the fintech space, so these are the comparable companies worldwide. So what is the pre-tax levered beta? What are their assets? What is their debt? What is their equity? So what is the post-tax leverage indicator? So like these are all US companies. So this debt post-tax leverage indicator can be 1 plus D by E, debt by equity, into 1 minus the effective tax rate. Okay. 1 plus debt by equity into 1 minus the effective tax rate. So this becomes a post-tax leverage indicator for me. So what is the unlevered beta for me then? So this is the pre-tax levered beta. This divided by the post-tax leverage indicator becomes the unlevered beta for me. Okay. So this is there for each of the years. So the median unlevered beta becomes what? This is the median unlevered beta for each of these years. So what I can do is that I can just take this thing and then my cost of equity, let's say is 10-year GSEC. And then I take the median unlevered beta. I take my market return as 10-year Sensex returns. Market risk premium is basically risk-free and market return difference. So my cost of equity is this plus B23 into B25, which is unlevered beta into 1 into market risk premium. Why I have not relevered it? Because it's a debt-free company. Otherwise, you could have relevered the beta also. And then you can take, let's say, the size risk premium here. And there is, for example, this study which has done the regression for small cap companies. And so you take the cost of equity as 20.43%. And accordingly, what you do is that you do this divide by 1 plus this. So basically you do the discounting on that EBIT and all. That is that which I talked about was the very basic of the valuation hierarchy, where all of this is like a very basic plain vanilla stuff. So that you take a two-stage H model and you arrive at the back. Now what is important for us that once we get the equity, for example, this equity value is $2.7 billion. Now, how do we allocate that between the various classes of instruments? So for example, if there are 6 classes of preferred stock in the company, and then there is common stock, and then there are these various options which are there in the cap table. So what will happen is that at different prices, these preferred stocks have happened. And that is what I am telling you is that each of these preferred stocks will have to be, they have issued at different prices. There is a 1:1 conversion ratio. So how much will be the number of shares post conversion? That you have to calculate. So what is the ownership there in case this is the on the current thing and on the diluted thing? So what if all of these options that I have issued at different prices? So then what if they also get exercised? So I can do a cap table in terms of what is the potential ownership. That is fine. But how do I allocate my $2.789 billion amongst all of these instruments? So what I have to do is that I can do the calculate the strike price for call option calculation. So what I can do is that initially, let's say enterprise value is 0. Now, if you look at that up to the valuation of 21,000 shares, 21,203 shares, what is the strike point? The total amount that I have received for these people from these things. Up to here, the whole money will be attributable only to these fellows. So the strike point for them is that up to $707,000, the whole money will go only to the preference shareholders. And then exercise of options will happen. So what is going to happen in this? What is the lowest priced option here? 0.37. So the participating class there will be the common stock also. So what will be the total number of options? Because above this is only common stock. So what is the strike point? How much? This will be what basically? The number of shares into 0.37, because that is when these options will come. Similarly, at the next stage, the both these options will also be exercised and the next options will also be exercised. So it will be this plus F32 into 0.68. So like that, each of the options you will do. Now, if you see the conversion price for series A is 1.88. So after 1 and 1.5, series A comes into the picture and series A has to be converted. What will be the strike point? The strike point here will be this got hanged. It's a fairly large file. So what happens is that at each stage, the strike point will keep increasing. Yes. So what happens therefore is that each of the stage you will see that the strike point. So now series A gets converted. Now after that $3.2 series comes. Then options at 3.2 happens. Then series B. Then options at 9.1. Then series C, series D, because after 9, these people have come into the picture, $15, $30. Then series E and F come later. And then $64. So now you see I rank all of this, and after this, the ranking happens. And therefore, the incremental equity, if I were to derive here, I stack them up. This is a very complex thing where now there are basically like 15 options here. And at each stage, if the company this much money were to be liquidated, this will come into all of these people's hands. Okay. And therefore, what I do is that the equity value which is there, there's a standard deviation of the volatility which we have taken, the dividend yield, etc. So I kind of create a option here, and then I create a Black-Scholes option pricing where I say this is the value of the underlying asset. 2797966. So basically $2.7 billion in each of this. The strike price is this. The SD of the underlying asset, the standard deviation we have taken, let's say for these companies, it is 28.27. Dividend yield is 0%. Time to expiry for all is 3 years. And riskless rate, let's say in the US is 4.36. So what we can do is, now this is like D1 and then norm function of D1 and then D2 and then ND2 and E into this, this into this, and therefore what is my value of the call options? And therefore what is the equivalent value of the call options? I can say is that, and then I can distribute the incremental call options between all of these asset classes. And finally, what I do is that I find that the enterprise value is of the total enterprise value, the allocation will be this, and hence you see that if the preferred stock is like 186, the latest round has happened, the common stock's value is only $78.53. So that is how interesting this can be, that depending on the cap table and all the complexities that emerge here, going back to our earlier example, that was if you were to do the exercise price and the stock prices on the grant date, if you have a level 1 input, which is the CCPS option, do not make the mistake of considering that the CCPS and equity should be valued at the same price. No, they have to be valued at different prices based on this option pricing thing. This whole OPM allocation has to be done, and that is how this will be. And yes, what we had also wanted to study was that what about the management stock options, which I had told you at the beginning. How do you value the management stock options of the company? So let's say the company has 3 milestones, that it has revenues of 500 crores and EBITDA of 2%. Revenues of 1250 crores, EBITDA of 4%. Revenues of 2250 crores and EBITDA of 4%. So depending on these milestones, the promoter will get different quantum of equity in the company. Now, as a valuer, what you have to do is that you have to assign probability to each of these events. That what is the probability for the EBITDA condition to be met? What is the probability for the revenue conditions to be met? And please remember that this is a multiply thing, because to get the shares, the promoter has to meet both revenue and EBITDA conditions. So therefore, if you look at the probability of this, it is the product of this and this. Now your question will be that, sir, how is the probability coming? Please explain. So okay, let me explain this to you. So what happens here is that the company has a particular revenue trend and a particular EBITDA trend. Based on that, you can say that, okay, what is the continuously compounding in the past, what is the CAGR? So for example, in 2 years, it has moved from 359 to 714. So it has moved at 34% per annum CAGR. So therefore, this will be this into exponent C10. It will be this into exponent function of 34%. Like that you can project. But now that is like a static cash flow. This may not be true. And what is the EBITDA percentage of the business? It is on this basis you can find. So if you look at the P&L, the mean revenue for FY26 is how much? This is what we predicted using the exponential function. And the end revenue is the next year revenue, like 2002. Okay. So what is the revenue growth? This is the using the ln function, ln RRI function, you can get this value. Now, your risk neutral growth rate, so your revenues are growing at 34.3%. Your risk premium is 7.7%. How do you get this? You are saying that the risk-free rate of return is 7%. The BSC returns are this. Your WACC is risk-free rate of return plus unlevered beta for your sector multiplied by the market returns, 14.7%. So what is RMPM? RMRP, basically RMRP is 8%, the risk-free rate of return assuming. So the risk neutral rate of return will be like your growth rate, historical C10. What is historical C10? Historical growth of return 34% minus J14. This. So basically the rate at which I am growing, 34% was the rate at which I grew, minus 8% is my risk-free rate of return. So my risk neutral growth rate is 26%. So now this 26% becomes risk neutral growth rate. And what I do is that I kind of do a Monte Carlo simulation. I have a drift here. So what happens is that my risk neutral growth rate is 26.6% minus the standard deviation to the minus standard deviation square divided by 2. I assume that my revenue standard deviation is 25%. Now what here that also you can do a calculation of revenue volatility. Based on past data, you can check the peers, etc. And let's say this is 25%. So then I have a shock. So there's a drift and there is a shock. And now I have to do like a 10,000 simulations, Monte Carlo simulations. And what I do is that I am just using a norm-inverse function where I'm generating a random value between 0 and 1. And what is my extrapolated value using Monte Carlo simulation? It is this value PNL L4 into exponential function Monte Carlo this plus this into this. Okay. So PNL L4. What is PNL L4? PNL L4 is my mean revenue, which is my starting point, into exponential. Now, what is that exponential factor? Revenue 26. So this is E2, which is the drift, plus E3, the shock, multiplied by the revenue FY26 Monte Carlo D7. What is D7? This is the random. So I am saying, okay, drift plus the shock multiplied by this random number. So accordingly, I simulate here. And then what will be my, again here, I can also project my EBITDA margins here. What I can say is that, okay, what is my historical EBITDA margin? My historical EBITDA margin I can calculate here. So my historical EBITDA margin here is, it is H30. So H30, my historical EBITDA margin is 2%. So what I do is that 2%, again, I can run a probability for 10,000 simulations. And I say that, okay, this is the probability at which my EBITDA margins will keep moving. And therefore, what is the probability that the revenue is more than 500 crores? It is this. And what is the probability that the revenue is more than 1250 crores? It is count if this whole set greater than 1250, that is the condition, and then divide by the total number of values, which is 10,000. So now I can get that what is the probability that the revenue will be more than 500 crores, 1250 crores, and 2250 crores. Okay. So 0.9975 and 6805. And then similarly, I can get that same condition on EBITDA also, that count if amongst all of these values, how many values are more than 2%? Amongst all of these values, how many values are more than 4%? And therefore, the EBITDA movement happens. Okay. So that is the cumulative probability that I can get. And accordingly, whatever is the now I have, like, for example, the milestone 3, the cumulative probability is only 11%. For the milestone 2, the cumulative probability is only 16.9%. So accordingly, what you will see is that this whole thing can now be calculated in a much more mathematical form. So that's so you see here. So what I have done here is that I am now able to calculate the probability that this is 96.4%, this is 16.9%, and this is 11.5%. This is the probability at which all of these things can happen. Okay. Now I'll open the house to any questions. Just to repeat this quickly because you might have missed. So what I have, like, I have the historical revenue trend. I see that the revenues are growing at 34%. My P&L, I see that the EBITDA is at that particular rate. So then I apply some sort of a mathematics. I calculate my risk neutral growth rate, 26%. I calculate, and how do I do that? My total revenue growth minus, let's say, that risk-free rate of return I was getting anyways. So from there, I calculate something called drift and shock. And I have assumed the SD of the value. And therefore, now I do a random simulation for 10,000 values here. And there, I can then do a extrapolation using my formula, P&L, last opening revenue into exponential drift plus shock multiplied by this random number that I generated between 0 and 1. And similarly, I can also calculate my historical operating margins also. And I can calculate this whole story here. Okay. So now I'm open to, just to recap the whole thing. We have discussed what are complex financial instruments. We've talked about concepts like fair value through P&L, OCI, amortized cost. We have concept like hedge effectiveness, etc. What does Ind AS 109 talk about all of this? Then what we have also looked at is hello. Yeah. So we have also looked at things like the actual valuation of a cross currency swap. And we have looked at a Monte Carlo simulation. We've looked at a Black-Scholes model, OPM Black-Scholes model. Now I'm happy to answer if there are some questions from the audience around this, because this was fairly complex stuff as compared to the plain vanilla DCF valuations that we might be doing. So now I'm happy to address any questions that might be there.
Thank you so much, Anuragji. It was an enriching session and a lot of information. It was so much knowledge sharing. So there are a couple of questions. I'll ask you one by one. So the first question is, can OCDs be issued to an individual?
Optionally convert, that I am not very sure, because that comes under the Companies Act. So the secretarial aspects will have to be checked there. So from a valuation perspective, there is nothing which stops or there is no view which a valuer has to take or whether OCD can be issued to an individual or not.
Okay. So the next question is, what procedures to be followed for warrants? Can this be used in startups?
Yes, a lot of startups use warrants. So basically, startups have issued warrants, convertible notes. There are different methods. So there's a whole set of secretarial compliances that are required for issuance of warrants and convertible notes. So that is there. So those are, so like section 62 governs issue of shares. So accordingly, there are different procedures in the Companies Act which govern issue of warrants, etc. And that can be done very much. A lot of startups have been doing that. Warrants, convertible notes. These are fairly instruments which are much in vogue.
Thank you so much. So the next question is, please discuss the treatment of bank guarantee which you gave an example. I'll repeat the question. Please discuss the treatment of bank guarantee which you gave an example.
See, as far as bank guarantee is concerned, what you will have to do is that there are different methods through which this is done. But again, it is like a Black-Scholes model where you're talking about a bank guarantee or a corporate guarantee. I'm sorry.
Bank guarantee.
Acha, you are giving a bank guarantee, but again, depending on the conditions of the bank guarantee under which they have been issued, what you'll have to do is that doing some sort of an embedded call option in that there is a call option that is given to the bank depending on the quantum of the guarantee, etc. So you can do the call and the put valuation here depending on the volatility, maturity period, etc. So here you'll get the value of the call and the value of the put, and the value of the guarantee will be the value of the put option. So there is again a mathematics to this in terms of volatility, maturity period, risk-free rate, etc.
Thank you so much. The next question is, if there is a swap of principal, then doesn't the liability note gets crystallized for the amounts agreed into? In the example cited for 82 USD, so whatever may be the fluctuation, the company liability is now secured. Why should company record on MTM? Can understand from bank perspective.
No, so that is why since there is 100% hedge effectiveness, what you will do is that you will restate the loan at 84. So there is a loss there. 82 rupees loan gets restated at 84. So you have a 2 rupees loss there. And since that was hedged under a foreign currency swap, you had a mark-to-market gain in the swap of 2 rupees. So 2 rupees gets knocked off, and that is why companies route that through OCI. So there is nothing which will impact. So both get offset here.
Thank you so much.
That is the reason why these contracts were entered into, right? That I don't want any volatility in my P&L. I locked everything from the very beginning.
So moving forward, the next question is how you discount inflation from revenue.
How you discount inflation? So inflation means, I think what you are talking about is nominal revenues and real revenues. So basically, whatever is the revenues that are growing at a particular rate, so that will depend on the WACC. So whether you are taking a real rate of interest in the WACC or a nominal rate of interest.
So right now, for example, if you're taking like a debt rate of interest at 12% or 14%, those are nominal WACs. So then the underlying revenue also that you will discount will be nominal revenue. If you discount that and you use real revenues, like you don't take a year on inflation, then in the WAC also you have to take only the real rate of interest, which is the nominal rate of interest minus the expected inflation. So real and nominal, that pair has to be kept there.
Thank you so much. So the next question is whether management stock options and promoter stock options are same. If yes, whether valuation model will change.
No, so basically promoter and management can be different, right? Management can also include the CXOs who are employees of the company, but they are so they are also getting like these options conditional upon certain performances. So PMS and means basically management stock options and promoter stock options, they are both can be done, but management may not always necessarily be promoter, and the condition treatment will be the same.
So moving forward, why we have taken historical growth rate based on just 2-year numbers?
No, that is a subjective argument. You can take it 5 years, or because earlier what was happening is that, let's say, because it was a startup, it started at like 10 crores and then grew to, let's say, 40 crores and then 100 crores. If you take that CAGR, because of the very low base effect, the CAGR will become very high. So it is very easy to double from 10 crores to 20 crores and 20 crores to 40 crores. But once you reach 500 crores, because of the large base, the historical CAGR will not be repeated, no? So that is why a lot of these startups, that CAGR the initial years will have to be removed from the CAGR calculations because of the base effect.
So moving forward with the next question. It's a very long question. So I'll just read it out very slowly. Preferred stock will be superior over equity in terms of A, liquidity preference, and B, dividend distribution. Let us presume that enterprise value had been computed using income approach. DCF method, using income approach, DCF method. Consequently, the going concern assumption would also have been made. If that is the case, the value would not have been liquidated. Hence, the liquidity preference of preferred stock would be worthless. Further, in the income projections used for DCF, dividend assumption would have also been made. Thus, dividend preference of preferred stock would also have been taken care. This being the case, if preferred stock is valued differently than equity, would it not contradict the assumptions using for arriving at enterprise value using DCF?
It's a very thoughtful question. And yeah, there is a school of thought which talks about this thing. But see, in the income approach, we don't take dividends. So as far as your dividend point is concerned, we don't consider that. Here, what we are saying is that hypothetically, if the company were to be liquidated, okay, so then if there are different strike points for the option, how will you value the superior liquidation preference? So you cannot discount the fact that there is a large. So what you are saying is that in a going concern concept, the liquidity preference as such is not relevant, which is a fair point. But that's how this is done because we assume these option pricing models that there is a pecking order. They are like, for example, if you have DVRs also, there are differential voting rights, or there are different classes of instruments in the US, class ABC. So accordingly, only we also consider their value ascribable. This is a method again. You can say that based on your approach, you can write that caveat in your report that you feel that they are contradicting each other, and you can take a view that they will be 1:1. But normally CCPS and equity should not be the same.
Thank you so much. So moving forward with questions. In Monte Carlo, the random numbers can be less than 0 or it has to be between 0 and 1.
0 and 1. We have taken 0 and we can take 0 and 1 because otherwise it can become, no, it will be, that's a mathematical process. It will be 0 and 1.
Moving forward, How hedge ineffectiveness is calculated when a hedge is denominated as a cash flow hedge?
The method is the same. So basically, the change in value of the underlying vis-a-vis the change in the value of the swap or this contract. This divided by this, A by B will be the hedge effectiveness percentage. And the treatment, whether it's a cash flow hedge or otherwise, that will keep varying. But hedge effectiveness method calculation is the same only. A by B.
Moving forward, many valuation methods are confusing investors. Which is better method of valuation and what compliances are required?
So if you were to ask, no, there is nothing written here because the valuation standards give equal consideration to income approach, cost approach, and market approach. So there are two schools of thought here. So one which say that the best method is a comparable company method, like a recent transactions. For example, there's a chain of coffee. So Third Wave Coffee has raised at this particular valuation. So then my company can also be valued at the valuation of Third Wave Coffee. The other school of thought says that because there are differences in size, scale, geography, operating structure, management, there are no two companies can truly be the same. And hence they say that, okay, whatever is like a dividend model they adopt, that if you are promising this particular cash flow streams and then I get discounted using income approach and this is the value. I think the best method here will be probably to play it safe, to take some percentage of CCM and some percentage of this income approach. Because anyways, the cost approach is not reflective of the future potential of the company. So between CCM and income approach, you have to take a judgmental call. Valuation, therefore, is part art and part science.
So thank you so much. There are more questions. What does the drift and shock value means and how do you calculate?
Again, that is a mathematical process. So basically what you are saying that if you kind of plot a scatter plot for all the values that will hibernate. So there's a drift here. And what if there is a shock? So then how much can be the shock that can be given to those values in case like there is an adverse event? So typical drift and the shock. So you calculate that mathematically using the method that I showed. Drift and the shock.
Thank you so much. So the next question is, what would be the valuation method for virtual digital assets?
Virtual digital assets. So I think if it's an asset, if it falls into the category of asset, the asset needs to be valued by its potential to earn future revenue. So the future earning income generating ability of that asset, that has to be discounted. That will be the valuation of the virtual asset.
So we have one more question. How hedge ineffectiveness is calculated in case of interest rate swaps designated as cash flow hedge?
So what we covered had that interest rate swap also. We had a principal swap and an interest rate swap also. So in case you don't have a principal swap, you just calculate the interest component. So the principal exchange will not be there. The later columns will be there. So only that you calculate using hedge effectiveness. That same framework, it will be calculated.
So the next question is logic behind using median levered beta, not average.
So the logic for median versus mean is a very common logic that there could be outliers in that whole sample set, which could distort the mean. Something like, in a typical B school, if there is one guy who gets like 1 crore of salary, that he or she becomes an outlier. So that value should be eliminated and we should therefore normalize the curve, form kind of a bell curve and look at the mid value. Arrange all the values in ascending order and look at the mid value. That becomes far more representative of the growth rather than distorted by outliers, either very low or whether high. Median will always be a much better reflector of any value rather than average. Plain simple average.
So that was all. Thank you so much for sharing your great insights with us. The session was full of knowledge and a lot of calculations, and it was a real learning experience for all of us. So as we end sessions, this session, we extend a sincere gratitude to our distinguished speaker, CA Anurag Singhal for his valuable insights and for taking out time and sharing his knowledge with us. We also express our gratitude to our chairman, CA Hansraj Chuk sir, vice chairman, CA Preeti Paras Savla ma'am, and the entire support team of ICAI for initiating and supporting this platform for the field of valuation and guiding us. Last but not the least, we would also like to acknowledge and appreciate our audience for dedicating your valuable time and for your active participation, even on a holiday. We are eager to meet you again in our upcoming sessions. Thank you so much and have a wonderful day ahead. Thank you.